we are talking significant amounts of money in a lot of respects, and there is some significant tax consequences with decisions that we make around tax planning when it comes to superannuation. Now, I want to say here, this is general information only. This is not personal tax advice around superannuation. It's very, very clear. But I wanted to just touch on a couple of points here. The first one is people understanding concessional contributions, and which is effectively a tax deductible contribution. So what are they, Julia?
Okay, well that's the trouble with them being called concessional and non-concessional. It just confuses people. Concessional is you get a tax deduction, non-concessional you don't get a tax deduction. Now the thing is, if you or your employer has claimed a tax deduction for this concessional contribution, then it goes into the super fund and gets taxed at 15 cents in the dollar as a minimum. There's another little nasty division called 293 that could tax it at 30 cents in the dollar, but I gather we're going to talk about that a little bit later on, are we, Ben?
Yeah, we will talk about, and that's obviously for those people on higher incomes that potentially get caught in that particular case. But when people are talking about salary sacrifice, what they're potentially talking about here is this concessional contribution, whereby any additional money that people are paying into their super, that money is only taxed at a rate of 15 cents in the dollar, compared to if you took that money into your life now and you're living, you may be getting charged tax at 30 cents in the dollar, or even higher if you're a higher income earner. So that's why a lot of financial planners will tell you that salary sacrifice can be a good thing, because ultimately you're paying less tax on that money. The trade-off of that is you don't get to see that money until you're 65 and potentially even 67, depending on when you were born. And some of the younger people might not even be able to see it if they change the legislation over the next 2 decades to potentially 70 and beyond, etc., etc.
Which side are you on? You're trying to scare them off. But this is...
No, I'm not. No, I'm saying, like, at the end of the day, you know, in terms of my personal view, and this is not advice, but my personal view is, what can I do with that money? What can I do to control and build wealth? And if I think that I can build wealth inside super and also outside super, which is obviously what I've done personally, again, not advice, that's the point I'm trying to make here, in terms of, you know, I can do models that can show great returns in super, but I can also do models that show great returns if I'm controlling an investment property, as an example, where I'm getting a greater return on the money because I've taken that cash and put it into an investment outside of super. Again, not advice, but certainly you know, an option for those people. Now,
this is the story I tell people, is if you got $10,000 bonus, right, you can tell your employer to put it into super and you'll have $8,500 working for you, right? But they say, no, I want to pay off my mortgage. And I say, well, then you tell your boss to pay it to you in cash, and you end up with about $6,000, depending on your tax bracket, and you paid off your mortgage, which you're only paying 6% interest on anyway. So not only have you got less money working for you, but you've got a lesser return on your money. So and let them decide what they can afford to do, because that's right, and obviously that decision for them.
That's putting it into offset, or again, if they make that money work through other investments, that's obviously the other alternative again. That's why you should sit down and speak to someone about the opportunity there. Now, in terms of the maximum contribution that you can make between the ages of 18 and 67, what is that maximum contribution in terms of concessional contribution that you can make each year?
Concessional, which is tax deductible contribution. It includes what your employer has put in for you, and that is $30,000. But am I allowed to discuss the unused cap at this point?
Yeah, absolutely. Go for it.
So if your superannuation balance is below $500,000 and you haven't been using up the full, well, it changes over the years. It used to be 25 and now 25,000. Now then it was 27,500 and now it's 30,000. But you get to look back over the last 5 years and say, well, I didn't reach those caps over that time. I can put extra in now to cover that.
So again, not advice, but if you've had a windfall of money that's arrived in your household, what Julia is saying is, if your super balance is under 500,000, you can work out the gap of what hasn't been paid, and you can pay all of that as a lump sum into your super and only get taxed on that at 15 cents in the dollar.